Welcome back. A strong showing from the Ambient Products category has given Libstar a boost. During the half-year period, revenue increased 5.2%, which resulted in double-digit profit growth, with headline earnings per share rising by 32.4%. And joining me now is the company's CEO, Charl de Villiers. Thank you so much for your time, Charl. Let's actually start off with that top-line growth of more than 5%. Talk to me about the drivers there. But also, I had a comment earlier on from an analyst saying that it speaks more to selling prices rather than volumes.
That is probably correct in the context of the consumer environment that we find ourselves in. We mentioned in our presentation this morning that the result was mainly driven by a resilient performance of our export channel, mainly to the US and European markets, but also an improvement in our contract manufacturing volumes in our wet condiments product categories, with volumes largely flat year on year, but with the price mix contribution of 5.4% driving that total revenue growth.
Well, how much pressure are you seeing there? Because, of course, you're talking about the uptick that you saw in the export division, but also industrial, but really looking at the retail division, particularly on domestic demand. How much pressure are you seeing there?
We mentioned this morning that retail consumers remain under pressure, and that's a fact. We can see that reflecting in consumer behavior, buying larger pack sizes or smaller pack sizes, mainly focused around the value offerings. So we've had to really do our best to innovate in terms of the categories in which we participate to meet those needs and to drive more value offerings to the consumers.
So would you say at this point, I mean, even with the price increases that we saw, that you're maybe still kind of faring well in terms of cost competitiveness?
That we pride ourselves in, and also that's a part of our simplification strategy that we started and embarked on a year ago. It surrounds, it focuses on our ability to continue to drive manufacturing efficiencies, because we cannot expect the consumer to bear the brunt of the inefficiencies and all of the market pressures. So we have done a lot in terms of cost saving as well as reliance on technology in order to drive efficiencies in our different factories.
And actually, Charl, how far are you in that simplification of your kind of operating structure? I mean, I see that even now you have two big categories outside of the non-food category.
That's correct. At the start of the year, we announced that we would be simplifying our portfolio to two super categories, one perishables and the other ambient. So we started with the perishables category, where we've significantly simplified the operating structure. That was the function of a 5-month-long fact-based process. So we'll implement that structure from the start of the second half and look to gain some additional efficiencies from that implementation. We're now embarking on the same process within the ambient category, looking to implement that by the end of the year.
All right. Well, I mean, of course, there are outside factors that also impact on the operations, including some shipment delays. How are you managing? Where's the pressure coming there from? How's it looking? But also, how are you navigating inventory management at this point?
It's been a focal point or a discussion point rather for quite some time since the advent of COVID, and that is the issue around port efficiency and supply chain disruption. In our businesses, we rely on imports of herbs and spices as well as finished goods, but also as a net exporter to the US and European and Asian regions, we are very reliant on port efficiencies. We mentioned this morning that in the period as well as post-period in July and August, we not only saw inclement weather, which affected the efficiency of the Cape Town harbour, but also the general inefficiencies of the harbour, resulting in increased lead times on imports and exports. So to mitigate this, we've had to increase our inventory holding, both of raw material and finished goods. But other than that, we are quite reliant on the infrastructure.
Yeah, we're talking about infrastructure and efficiencies. Let's talk about your capital expenditure focus, at least for the short to medium term.
Yeah, we've mentioned in the past that the group has invested in capacity enhancing projects for a number of years. So we've reached a point where we've refocused our capital allocation towards what we refer to as frugal innovation projects, smaller projects to improve our efficiencies. And in doing so, we've reduced our capital expenditure during the period from 120 million rand to 80 million rand, and we will be spending less or at the lower end of our normal target range for the full year, and that also improving our gearing ratio of the business and improving our general profitability at the bottom line level.
All right, I hear you on that. Well, Charl, before we wrap up the conversation, just your outlook and really what you will be focusing on to continue to drive this momentum that you have seen in this interim period for the next 6 months of the financial year.
Our strategy remains one of simplification, so further simplification of the portfolio. We've mentioned today that we've exited one of our HPC divisions. We will be looking to do the same with the remaining business in the coming months, as well as to further rationalize the portfolio. Other than that, supporting the retail demand with some dedicated promotional activity in the second half, which is traditionally a busier period for us, as well as to continue to execute on the strong pipeline of export orders that we have in play.
All right. Well, thank you so much for your time and for giving us more detail on those numbers that came out from Libstar this morning. Charl, that was the CEO of Libstar, Charl de Villiers.